And I guess I should also ask, is there someone willing to offer an opening prayer? I mean, I think you should get a pass if you did it last time, but not really. I mean, if you want the blessings, take them, take those blessings.
I can say it.
Awesome. Thank you.
All right. Dear Heavenly Father, we're thankful for this day, and we're thankful that we're able to gather together as a class. And please bless that we can have the Spirit in this meeting, that we can continue to learn from each other and say these things in Jesus Christ. Amen.
Amen. Thank you. I heard. I don't remember who it was. Was it Rebecca and Scott were talking about the presentation assignment, and Scott said, I'm going to quote you. This is a paraphrase of what Scott said, but in essence, he was pretty worried about it too when he first saw that he had to make a presentation, but after doing it, it's not too bad. Is that close? Okay. And so I would say that I think that's what most people say. And so if it's something that's freaking you out, like don't worry too much about it. It's not too bad, but it is worth a fairly sizable chunk of your grade. And seriously, it's an easy A in the sense that if you just do your best and post a video, I give you full credit on it. I know there's a rubric in there, but to me, so if you, it's one of those, if you do it and do a reasonable job, I'm good. Because I recognize that it's scary for some people to put that thing out there. Anyway, so to me, it's like, again, I like the mantra, if you're into mantras. I was recently in a job interview, and one of the candidates started with affirmations, and he says he starts each class with affirmations. I'm like, maybe we need to do that. Like right now, we could all repeat like, I will be good at accounting or something, but I won't make you do that. But the mantra is like, control what you can control. Because exams are challenging in the sense that even if you've studied and everything, sometimes if you're like me, sometimes you don't do as well on the exam as you hope to. But the homework assignments, the mostly the quiz access and the quizzes, they allow enough leeway that you can usually get your grade up fairly high on those. That's something that's more controllable. The presentations, that's controllable. That's something you can work through and put out a good product. And there's only 2 of them, and those 2 of them add up to whatever. I'd have to look at the thing, but like a fair percentage of the grade for the course. I want to say, you would think I would have that memorized, but I want to say, I'm going to look just so you know. Assignments. It's loading, or as my granddaughter would say, it's woading. She doesn't like when she's trying to load her movie on Disney Plus and it's woading. It's always woading. Let's see. Yeah, so homework support is worth 10% of your grade for the whole course. So you'll do 2 presentations in the course, meaning each presentation is worth 5% of your overall course grade. And all you have to do is, in essence, put together a presentation and post it and auto A on that 10% of your grade. Like, that's how I try to look at it. So that seems, like something worth doing. Although, I have a student in one of my classes I teach for Arizona State University right now, who it's so terrifying for this person to give presentations that they took a full letter grade drop to just not do it. I mean, for the course, they're just like, I'm not presenting. Okay, but that's going to impact. Okay, so I recognize it's terrifying for some people. Anyway, and just, I will put out there, if that's you, if you're like, this is terrifying for me, I would entertain, instead of doing a video, if you put together a PowerPoint presentation that step-by-step showed how to complete the problem or something like that, I would, that'd be reasonable to me. That'd be a reasonable accommodation for that fear. So, don't let it scare you. All right, I'm talking a lot, which I do. I apologize. Any general questions about stuff this week before I maybe launch into some topic related stuff? Yeah, Tammy, you're on mute.
Okay,
There you are.
that's because you don't want to hear the kids and the grandkids and the cat. Um, so on the homework where it says enter your answer in millions, is that the way it's written, or do I need to add a bunch of loads of zeros on there? I'd
Yeah,
rather
no,
find out before I hit submit. So
it's a good question. And so actually the information is given to you in millions. And so your answer would be written in that same in the same thing. When we say, like, you'll look at, like, if you go to Yahoo Finance or somewhere and you look at a financial statement, if it says in millions, it means they've removed 6 zeros. Okay. So like if you were to write 21 million in millions, you'd just write 21. But for that problem, the data is given to you in millions already. And so, you're already working in millions, so to speak. And so no change is really necessary to your answer, if I'm remembering the problem correctly on the financial statement analysis, right?
yeah.
Yeah, that's confusing to everybody. And you'll see that in real life, looking at statements, they'll be in thousands, which means they removed 3 zeros, or in millions, 6 zeros. And for the gargantua companies in billions, Bank of America has assets under management of over $1 trillion. So that's with a T. That's 9 zeros. So that's I can't conceive of it. Have you ever tried to conceive of even like $1 billion? Like, I know what a dollar is, and then times 1,000. I know what $1,000 is. It's not as much as it feels like it should be, but and then 1,000 is 1,000,000, which most of us don't have. And so, and then you're like, if I had $1 million and I could earn 6% on it, that'd be 60,000 a year. That'd be a decent salary. And then a billion is 1,000 times 1,000,000. And then you get outside of the realm of what my brain can handle. So that a 6% return on $1 billion is $60 million a year. So all I need is $1 billion, and I think I could be happy. Not, I don't know if I'd be happy. I'd be financially comfortable, but I'd probably still be grumpy. So money doesn't seem to fix that for people.
Yeah.
Other other questions that I can ramble about? No, I will. I'm going to tighten it up right now. I promise.
That's all I found so far.
Okay. Well, let me pull up a little bit of a slideshow here and quickly go through a few things that might be helpful to you. Is everybody feeling like really solid on the idea of debits and credits and how that works? Like, maybe give me a thumbs down if you're not, or something. All right, because I do think it can be confusing when it's new, like a lot of things can, right? Like, I stink at playing the ukulele because I don't play it enough. And so that can be confusing at first. But like anything else, with practice, you can get better. So let's see, where are you at? I thought I had that open. Yeah, with BYUI switching me to doing 2 different classes, I always think I have one open and I have the other class open or something. So let's see, chapter 2 stuff. So I'm going to go through some of this pretty quick. In fact, real quick, because if you're feeling good about debits and credits, then it'll just be a quick review to kind of run through some transactions, and see if you have any questions pop up. Yeah. So Rebecca asked, can I go into more detail about what normal means? So yeah, I happen to have something right here that we can look at real quick. So let me share my screen. All right. I'm assuming you mean normal accounts or normal balances in accounts as opposed to normal people, because I don't believe that there's such a thing as normal people. We're all pretty weird. It's just part of being people. Anyway, if that offended you, then you're pretty normal. All right. Sorry. Anyway, so up here, I've got assets, the accounting equation, assets equal liabilities plus equity. And then you can see that the asset account shows a normal balance on the debit side, and the liability and equity accounts show normal balances on the credit side. And so the question is, well, what does that even mean? And so I don't know what the person who coined the term meant, but to me, the normal balance is the side of the account, debit or credit, where I would expect to see a balance. In other words, it's the positive side of the account. So for assets, they increase with a debit. And so we would expect an asset account to either have a balance of 0, meaning we don't have any of that asset, or a debit balance, meaning we have a positive value. You can't really have negative cash. People always talk about having negative cash, but what they really mean is that they have a positive liability and no cash, right? It means they have debts that exceed their cash, but you can't really have negative cash, okay? You either have cash or you don't. The same with equipment or land. You either have land or you don't. So if you don't have land, the balance of your asset account land would be 0. If you do have land, it would be a debit balance. So the normal balance is the side of the account that increases the account. So for assets, that's the debit side. And for liabilities and equity accounts, that's the credit side. Again, you can't really have negative liabilities. Either you owe money to somebody, which would be a credit balance in your liability, or you don't, which would be a 0 balance. So I don't know if that helped or clarified, but really, if you just remember like the fact, which is the normal balance side is always the side of the account that increases it. And then the sort of why behind that is because we would expect to see a balance, a debit balance in asset accounts and a credit balance in liability and equity accounts.
That actually helped a lot. It just didn't really explain it in the chapter. It just kept mentioning it. And I'm like, what? So that does help.
Yeah, I feel like sometimes the problem with accounting textbooks is that they're written by accountants. And so, and what I mean by that is that's all textbooks are written by experts in their field, right? And so they just are like, yeah, well, that's the normal balance. And you're like, thanks. Okay, it didn't help. So anyway, so a couple of things here, or I'm gonna run through. So we learned about journalizing transactions. Okay, this is a little, I think this is a bit much with all the arrows and stuff on this slide. But in essence, all journalizing a transaction means is to record the transaction. And so it's sort of the chronological recording of transactions as they happen. So in this case, the owner contributed money to the business. That's the transaction that's dated December 1st. And so we're showing an increase to the cash account and an increase to the common stock account. And so we do that by debiting the cash account and crediting the common stock account. And so we record it like this. So in financial software like QuickBooks, you can, if you want to, actually record transactions in a journal entry format like this. But QuickBooks is actually, it doesn't force you to for a lot of transactions. Any transaction that involves your cash account, you can actually do it in a little thing that looks like a check, like you're writing a check, or like you're receiving payment from a customer. So you never have to see the journal, but it's still recording it in that fashion. But if you want to, if you're an accountant who's used to that, you can enter it in this format. Just recognize that each journal entry has to have a debit and a credit, and they have to equal each other. Some journal entries will have, 2 debits and a credit. And so as long as the debit sides and credit sides equal each other, they're fine. So, I mean, the features of a journal entry are that you have the account being debited is always listed first with its amount, and then the account being credited is listed second with its amount in the credit column. This second transaction is the purchase of supplies for cash. So our supplies are going up, our cash is going down. So again, I would go through this process in my brain. I just go through it faster now that I've done it more, of saying, okay, supplies is an asset, assets increase with a debit. So I'm going to debit supplies. Cash is an asset, assets decrease with a credit. So I'm going to credit cash. And then I'd make my journal entry, right? I mean, I still go through that process every time I have to do it. It's just do it for 20 years and it happens faster. Let's see. So let's see.
Really quickly before you move off
Yeah.
journaling, how would you journal a partial payment? Because I did that on the homework last week and I got it wrong, but I wasn't sure why.
A partial payment,
Mhm.
like am I being paid or am I paying someone else?
I mean, I can just read you what the thing was. So it just says the company received 6,720 cash as partial payment for the work completed on April 9th.
Yeah, so the fact that it's a partial payment doesn't really matter to me as an
Okay.
accountant. I'm just gonna say, well, what's happening here? If I'm receiving cash, my cash is going up, and then what's it paying for, right? Is it revenue that I earned? No. Is it paying off money that's owed to me? Yes. And so I would say cash is going up, accounts receivable, money that's owed to me is going down. And so I would debit cash and credit accounts receivable that amount.
Okay, that's weird because I did do that, but it said it
Uh-huh.
was wrong for some reason and I wasn't really sure.
Okay, well, yeah, without seeing it, I mean, do you have a feedback screen that we could see, or
I
because if you
would not even know how to do that.
okay. Um, okay, maybe that's something we could talk about in a few minutes. We could look at how to see your problems so that you could get
I mean,
some
it
feedback.
was exactly how you described. I don't know why it's wrong because it is just like I did debit cash and credit accounts receivable. So
Okay, well, I could take a look at the specific one after we get done
okay,
and provide you with some feedback.
I appreciate that.
Do you know what homework it was on?
Here it
Was it the
was the
quiz or
lesson 4 homework.
the quiz access?
Yeah, the one in the textbook, the McGraw-Hill one.
Okay,
It was from week 2. It was the last assignment we had.
okay. So we do these chronological journal entries. Each time we have a transaction, we record it. And that's what I mean by chronological, right? We're not worried about it, just as they happen, we're recording them. So after we've done that, we then post our journal entries to what's called a ledger. And a ledger helps us keep track of the balance of the account. So there's kind of 2 versions of the ledger that you'll see in the course. The first is this one. That actually looks a little more confusing than the other, which is the T accounts, which you've already seen. But here, in essence, what you have is the ledger is done by account. So whereas the journal, it was the transaction, and then we put which accounts are impacted. The ledger, there's a separate ledger for each account. In the good old days of accounting, actually pre-me, okay, because I've always used computerized accounting, you had like a ledger book actually. And so the first section of the book, if you've ever seen these old accounting books, was a journal, and you recorded transactions in that journal as they happened. And then at the back were ledgers. And so you would have kind of like tabs or a separate page for each account. And so then I would say, okay, I just debited cash, $30,000, and you'd flip back to for the ledger for cash and write a debit of $30,000. Here you can see that this transaction dated December 1st, we debited the cash account $30,000. And so the balance of the account is $30,000. Then on December 2nd, we credited the account $2,500. So now the balance is $27,500, $30,000 minus the $2,500. On the 26th, we credited the account $26,000. So now our balance is $15,000. And then this little PR is just, it's telling us where we recorded what page in the journal we recorded it. So it was recorded on page G1. And so you could reference back, again, if you were doing this by hand, you could reference back to page G1 and see that journal entry. The reason you do that is because if you have an error, you want to chase down where you wrote it, did it wrong, right? So that's a journal. So again, how would we post a journal entry to a ledger? Well, here's our journal entry, the debit to cash of 30,000 and the credit to common stock of 30,000. So then again, here's our I don't know what word I'm trying to think of here, but it tells us what page to go to. So we flip to the general ledger, page 101, and see that we wrote a debit for cash and the balance to cash. So that's how it was done. And then for common stock, that's on page 307. So, all right. So I'm going to just kind of quickly go through some of these transactions to kind of, I guess, review the process. I know for most of you, this is probably review, but real quick. So here's the first one, like we just looked at, where the owner contributes $30,000 to the business. So we debit cash, we credit common stock. Why? Because cash is an asset, it's increasing, and assets increase with the debit. And common stock is an equity account, it's increasing, and equity accounts increase with a credit. Then we would post it to our ledger. So this is the other version of a ledger. We just call it a T account, and we just have the title of the account, its account number, and then this T with debits go on the left side, credits go on the right side. And again, it helps us tally up the balance of the account when we get to the end of the transaction or financial period. Again, if you have questions along the way, just interrupt me. There's no easy way on Zoom, so let me know if you have a question. Here's the second one. We purchase supplies for cash. So in my brain, I say, okay, what's happening? Well, then my supplies would be going up, my cash would be going down. They're both assets. So the asset increasing would be a debit. So the supplies asset is debited 2,500. The cash asset is credited 2,500. And then I post those over to my ledger.
Remember that the PR is your posting reference number. That's the page number.
Thank you. Yeah. Thank you. I could not think of the term reference. So I appreciate that. And again, straight up honest, I never deal with posting reference numbers in accounting. I do right now because the software I'm doing is posting it for me. All I have to do is enter the journal entry. So often though, like I don't do a lot of entering of the journal entries. When I do, I get called upon to when we're in like an audit scenario to go back and find a specific transaction, right? And so if I was doing a book, I would need those posting references. In a computerized system, I can usually just double click on the transaction and it'll bring up the reference and any supporting documentation we have. Anyway, all right. Third transaction, we purchase equipment for cash. So again, I say, okay, what's happening? My equipment assets going up, my cash assets going down. So that'll be a debit to equipment, credit to cash, and then I can post them over to get the balances to my ledger. All right, we purchase supplies on credit. So remember, the secret term on credit means we're not using cash, but instead we are using debt. Okay, we're using a liability called accounts payable to pay for that. So now I say, okay, my supplies assets increasing, but it's not cash going down. Instead, it's a liability called accounts payable also increasing. And so liabilities increase with the credit. So I will debit supplies, the asset, and credit accounts payable. I provide services for cash. So my cash is going up and my consulting revenue is going up. Okay. Cash is an asset, so it increases with a debit. Consulting revenue is it's a revenue account, which impacts my equity in a positive way. And so revenue accounts increase with a credit. Payment of an expense for cash. So my cash will be going down and my expense will be going up. Again, this confuses people because you'll see this negative, but this is actually an increase to our expense account, but that has the impact of decreasing our equity account. So that's why they show it as a negative here. So expenses increase with a debit and assets decrease with a credit. So I'll debit rent expense, credit cash. Another payment of expense in cash, same way, I debit the expense, credit cash. Probably if you were doing journal entries for a business, probably the most common transaction you would be doing would be debiting expenses and crediting cash. Okay, that happens over and over. If you think about like what happens the most in, say, your household finances, you're paying expenses in cash, or you're recording revenues, and so then you're debiting cash and crediting revenues. Like those are probably some of the most common transactions you'll see over and over, because we got to pay our expenses. So that's one that you just start to learn. Whenever I'm paying an expense with cash, I debit expense, credit cash. If I'm paying an expense with the promise to pay it in the future, meaning on account, then I would be debiting the expense and crediting the accounts payable. Those are the very common transactions. Here we provide consulting revenue on credit. So we did work for someone. We also had some rent revenue, but we haven't gotten paid for any of it. Okay, so our accounts receivable asset is increasing, money that's owed to us. And then our revenue accounts are increasing as well. So assets increase with a debit, revenue accounts increase with a credit. So we'll debit accounts receivable, credit consulting revenue. This is our first compound entry. And what I mean by compound entry is it has more than just two accounts being impacted. We have three in this case. So our consulting revenue is going up by 1,600, our rental revenue is going up by 300, and all total, that means our accounts receivable is going up by 1,900. So as long as our debits and our credits equal each other, we're in good shape. Here we received some cash. So this was money that was owed to us. Now we're getting paid by the customer. And so at that point, our cash goes up and our accounts receivable goes down. Again, so that this is also a really common transaction in real life. Someone paying you for money they owe you. Okay, especially if you're a business that extends credit to customers, then this happens all the time. Here we make a partial payment on our accounts payable. So we, again, when it says you make a partial payment in the instructions, don't worry about what that means. You're just asking yourself what accounts are impacted and in what way are they impacted. So when I make a payment, my cash goes down and my liability accounts payable goes down. So accounts payable, a liability decreases with a debit and an asset decreases with credit. A couple more and then we'll move on. Here we pay a cash dividend. That again, that when you pay a dividend, it means you're paying money, a share of the business's profits, or I guess they, in theory, don't have to make a profit, just some of the business's capital out to the owners. And so it's always going to be a negative to cash and a negative to the dividends account. Dividends, like expenses, decrease our equity. And so their increase is shown as a negative when someone's looking at it in terms of the accounting equation. But just know that we always, again, when a business pays a dividends, it always looks the same way. A debit to the dividends account, meaning dividends is increasing, and a credit to cash because we're paying out cash.
Brother Fox?
Yes.
In the chapter assignments, I think it was chapter 2, they gave the incorrect, they didn't give you that as one of the correct answers for one of the questions it asked.
Okay, I'd have to look at the specific question if you want me to.
I actually snapped a picture of it. I'll send it to you in email.
Okay, cool. Yeah, because sometimes I've seen ones where they try to, as you know, McGraw-Hill likes to be tricky. I think what they're trying to do is, see how deeply you understand the concept. But, I've seen ones where they'll say something like, the company declares a dividend, and then you're supposed to put like, the dividend and dividends payable, and then they'll say like, the a certain date is reached, like and no transactions, so I'd have to see it to know if they were trying to be tricky like that, or if it's just an error that we need to report to McGraw-Hill. I will say that occasionally I come across errors in McGraw-Hill, but I will also say it's pretty rare. In other words, they have it relatively tight, and so I always hesitate to say I find errors because then like I'm inundated with student requests to check for this error to the point where I'm like, I can't handle 50 of these. And so it's like, I don't want to, but I am totally willing to go look if you think there's an error. I just, like I would make your first assumption would be that you made the error and then you double check it before assuming it was from the book. All right, receipt of cash for future services. So somebody pays me money for services I have not yet performed. This is like super common in my business. I own a storage rental business. And so it's very common for people to pay me in advance for future rents. You know, they just say, hey, instead of me paying you $50 a month for this unit, can I just give you $600 for the year? So when that happens, my cash is increasing, but I can't record it as revenue because I haven't earned it yet. So instead I record a liability called unearned revenue. This is one of the most confusing accounts for people because it has revenue in its name and everybody thinks of it as revenue, but it's not, it's a liability. Because if someone pays me in advance, I either owe them the services I promised to perform to them in the future, or I owe them their money back if I don't perform those services. So unearned revenue is a liability. So my assets going up, my liabilities going up, assets increase with a debit, and liabilities increase with a credit. This is a similar idea. I'm going to pay cash for future insurance coverage. So I'm paying for a whole year's worth, or actually this says 2 years, 24-month insurance policy. And so same idea, I'm paying cash for it, but I haven't really, it's not really an expense until I get the insurance coverage for it. So instead it creates an asset called prepaid insurance. And when we get into adjusting entries, this will become a little clearer why we do this. Anyway, so in this case, I have an asset going up and an asset going down. So prepaid insurance is debited and cash is credited. I purchase supplies for cash. Same thing, an asset going up, supplies, and an asset going down, cash. So I debit supplies and credit cash. And I pay an expense in cash. We've already covered this ground, but they want to give us another one. So every time I do an expense for cash, I debit the expense, in this case, utilities expense, and credit the cash account. And another one, salaries, expense, and cash. All right, I think that's probably plenty of those. I hope it was useful to go through them and just kind of think of them. And sometimes people just say it's useful to hear how another person's process works. So that's why I do that. Oh, you know what? I want to show you one more slide that I think's worth checking out. Actually, I'm going to show you a couple if you don't mind. So after we do all that, and we've been recording things in our ledger the whole time, then it's super easy to find the balance of each account, right? Cash, we had the debits, we had the credits. And all we do to find the balance is add up both sides, subtract the smaller side from the larger side, and that'll give us our balance. So in this case, we had all of these transactions in cash, debit transactions and credit transactions. We added up the debit side, we added up the credit side, we subtracted the credit side from the debit side and ended up with a balance of $4,275. We would say that this account has a debit balance of $4,275. And because it's an asset, we would expect it to have a debit balance. That's its normal balance. Accounts receivable, since it had a debit of $1,900 and a credit of $1,900, has a balance of 0. You'll notice when an account has a balance of 0 that they always write it on the debit, the normal side. So for asset accounts that have a balance of 0, they'll write it on the debit side. If a liability account had a balance of 0, they'd write it on the credit side. That's just a standard thing. So supplies, prepaid insurance, there's all of our assets. Here's our liabilities. You can see there to find the balance, we had a debit of 900 and a credit of 7,100. So the balance is the larger side minus the smaller side, and then the balance ends up on that larger side. So we'd say accounts payable has a credit of 6,200, and then finally our equity accounts. So once we have all of those, then we can create a trial balance. And this sometimes confuses people, but all a trial balance is this information, the name of the account and the balance of the account, all summarized on a single document. So we just have the name, the name of the account, asset or cash, and then its balance, a debit balance of 4275. Often accounts that have a zero balance will just not be included on the trial balance. This one, they happen to show it with a zero. And you'll always see the accounts in this order: assets, followed by liabilities, followed by equity, then the dividends, then revenue and expenses, always in that order.
I kind of have a dumb question in regards to that.
Okay.
So when you do that within that order, does it, I mean, is it like common practice that it goes within a certain order within that order? Like it always goes cash, accounts receivable, like in order like that way? Does that make a difference?
Yeah, so I think for most of the problems we'll be doing, it doesn't, but there is a kind of standardized order, kind of. And what I mean by that is cash is almost always, cash is always first, and then accounts receivable. And so the assets are listed in order of their liquidity, okay, which means, when we get into classified balance sheets coming up here, there'll be more on that. But liquidity in essence means either how easily assets are converted into cash or are used up or consumed. So like cash is already cash, but like supplies, we intend to use those up. Prepaid insurance, we intend to use that up. Accounts receivable, we intend to collect all within the next, certainly within the next year. So and then things like equipment are longer term in nature. So the short answer is yes, but the longer answer is you don't have to worry about that yet, but we're going to get to that more.
All right, thank you.
If that helps. And you're like, not really, but kind of, I guess. All right. And so then once we have a trial balance, it's super easy to create a financial statement from that. Well, why? Because I've got all my account balances summarized in one place. I have my revenue and my expenses. So that's an income statement right there. Okay, I've got my assets, my liabilities, my equity. There's my balance sheet right there. And I have my equity accounts and my dividends, so I can make my statement of a stockholder's equity. And so anyways, I just wanted to kind of bring that up. So there's our income statement, revenues summarized, expenses summarized, and our net income. Our statement of retained earnings, or stockholders' equity, sometimes they'll call it. That's just going to have our retained earnings at the beginning of the period. Retained earnings just means money that the business has earned and you haven't paid out to the owners. Okay, so the new business had zero retained earnings because it just started. We add the net income, which we just calculated on the income statement, subtract any dividends, and then now we have our retained earnings at the end of the period. When we go into the next month, January 1st, the beginning retained earnings will be $3,195. We'll add any net income, subtract any dividends, and that'll be our retained earnings. And then finally, our balance sheet, which has our assets all summarized, our liabilities, and then our equity, which is our common stock and the money we've put into the business, and our retained earnings, the money we've paid out. So anyway, so that's about all I wanted to cover on that. So then now I would entertain any specific questions you might have about either about this material or about something from the, let's say, from the assignment or something like that. If you just popped in and you're in Accounting 101, this is a meeting for Accounting 201. You're totally welcome to hang out, but just don't feel like you missed the whole meeting or something. It's because it's for the other class. But we're also covering similar material right now, so it would look very familiar.
I got a question for you.
Yeah.
You mentioned that the document, the retained earnings document, is also called stockholder something or other. What was that?
It's the statement of retained earnings is sometimes called like a statement of stockholders' equity, or an equities. I mean, but for this course, I made a mistake by mentioning that a lot of these have different names, right? Your income statement is sometimes called a profit and loss statement. or P&L or things like that.
That makes more sense now. Okay.
Yeah.
Thank you.
Yeah, that's one of the hard things about accounting is like there's a bunch of terms that are synonymous. And so it's confusing. And then there's terms that are like nearly synonymous, like this statement is almost the same as this one. But for this course, we're using that statement of retained earnings.
Okay, thank you. I really appreciate that.
Other questions besides the one Noah had asked about that I was going to look up for him, and then Larry said he was going to email me about something.
Actually, just to clarify, I had like triple checked it and I just put one of the numbers in backwards, like just completely by accident. So I did get that solved.
Okay, cool.
Mm.
Well, Noah, you're still a good person.
I tried.
even though you made a mistake in accounting. Like,
What does your shirt say, by the way? I
oh,
saw it.
I accidentally wore this shirt. I apologize. This was given to me by my coworkers. So at Eastern Arizona College, where I worked full time, I'm the division head, and at the end of this year, I'm stepping down or we're actually getting rid of division chairs. And so anyway, so they gave me a lunch, and it says I make accounting look sexy. And so I should not have worn it to this meeting. If that offends any of you, then sorry. What I tell all of my students here is accounting as a career is 40-year-old sexy, but it's not 18-year-old sexy. And what that means is like, I don't think like anyone's going to chase you down and be like, ooh, you're an accountant. But when you're 40 and you're making 120 grand a year for an 8 to 5 job, that's pretty sexy. Okay, so it's it's 40-year-old sexy. Anyway, so it's something that my coworkers thought was funny, I guess. I apologize.
I got a question. Could you, because this has been baffling me for the last 3 classes I've taken where there's accounting involved.
Mhm.
Debt ratio, leverage ratio, because when you Google it, there's nothing that tells you what's better than another. I have had 0 luck. So like this one, it was which debt ratio is better. So is it supposed to be I would assume it's the less, but I don't know.
Sure.
Right.
Yeah, so the debt ratio is your liabilities to your assets, okay? And so, I mean, if you think about ratios in general, all they are is a division problem, right? 2 numbers, one divided by the other. And so a debt ratio is your liabilities, money you owe people, divided by your assets, money that, or stuff that you own, okay? So the way I like to think about it is if I had the same amount of debt as I did liabilities, so I had I had $100,000 in liabilities and $100,000 in assets, then my debt ratio would be 1, right? Because it would be 100,000 over 100,000. So as my liabilities climb relative to my assets, meaning if I had $200,000 in liabilities and only 100,000, then my debt ratio would be 2. So the higher that number climbs, the more debt I have relative to my assets. So higher is worse, typically speaking, okay? And lower is better. If I had $100,000 in assets and $50,000 in liabilities, then my debt ratio would be 0.5. So higher means more debt relative to your assets. Does that help?
Yeah. And so does that mean, is that the same thing as when it's saying in financial leverage? Is that meaning that?
So, yeah, so, so leverage refers to the use of debt when we're talking in financial terms, okay? And the idea is this, think of like if, when I use a lever to leverage and lift something, I can lift something heavier than I would have without the lever. And so we can use debt in healthy ways. If I, for example, with my storage, my building was full and I had customers begging me, okay? And so it was worth it to me to go ahead and borrow money and build a new building that I knew I could fill right away and pay that money off. And so, I was leveraging the assets I had, the land and the building, to add another building so that I could capture that revenue while the market was hot enough to do that. And so the term leverage does have to do with our use of debt. And typically what we're thinking is, are we using it? For me, what I'm asking is, am I using this in a healthy way? Larry, you have some experience through your career, is that right? I mean, you might have a different perspective, or maybe you don't. I just thought I would give you a chance if you wanted to address the question.
I do.
Do you want to share anything or not really?
Not really.
Okay. But he does not have to. That's sometimes just another perspective. Anyway, does that help or not?
So if it's saying, like this, the question that I skipped, it said which year did it employ more financial leverage? So if you don't know, that's like they're building another building, so there's an end game. How do you just go by the percentages?
Yeah, what was the question was what? Which unit employed more leverage?
In which fiscal year did it employ more financial leverage? It was question 1 on the financial analysis homework.
I would want to see what.
I am too, and I'm struggling with.
Well, I'd want to see the context of the rest of the question, I guess. Let me give you a second. I'll pull it up. Because yeah, I would say typically that means when did you have a higher debt ratio, but that's the thing with sometimes with McGraw-Hill, you're like, hey, McGraw-Hill, just tell me what you want from me. Quit being obtuse, right?
Yeah.
Like I can do the math. I just need to know what you're looking for.
Right.
So give me a second and I want to look at it. And so I'm giving you an intelligent answer. Although my kids think that I specialize in non-intelligent answers. So it's possible that that's true. Let's see.
You know, it's interesting in that same question, the appendix A that gives you all the financial documents for Apple that we refer to answer all these questions. They actually have the shareholders, what was it called?
Statement of return earnings.
Shareholders, consolidated statement of shareholders equity. And that's one of the reasons I was asking you what you said, because I saw it on there. And then they had, it wasn't P&L. Statement of operations, comprehensive income. Anyway, so your previous comment did help with that. Even though you said you didn't want to confuse us, it actually did help.
So what am I looking for here? I'm on
It's question 1. It's part 4.
Part 4 of the second one.
Of the first question.
First question.
First question, part 4.
All right. Sorry about that.
It's okay.
All right. Is Apple's current year return on assets? No, wait, I'm looking at the wrong thing here.
Well, it's the 4th part of that one. It's that same.
Yeah, that's number 4.
Yeah.
That's required number 4.
It says in number 4, it says in which fiscal year did it employ more financial leverage?
That's what I'm saying. I'm looking at the wrong thing.
Okay.
Is this the week 2 or the week?
Brother Fox, we're on week 3, and it's the.
Well, I know what week we're in, but I thought you were asking a question about the week 2.
No, it's
number 1.
It's the homework from that says week 3 financial statement analysis.
All right, for chapter 2. Thank you. There it is. Okay, number 1. I also think it's tricky when it says there's only 3 questions, but each one has 4 parts. That's 12 questions, buddy.
Yeah.
All right.
Yeah,
it's a dirty trick.
Or it's
all right.
2 points, but it's 87 pieces.
you're like, you know what? I'll just take a 0 on that one. It's too big.
Yeah,
All right. Sorry. So here I am now looking at it. So it had you go through the amount of total liabilities they had, then total assets, then calculate the ratio. And then in which year did they employ more financial leverage? And yeah, that's another way, honestly, what they're saying is, in what year was their debt ratio higher? But which is what I assume, but I'm like, sometimes I don't know unless I'm looking at it. I will tell you this, let me just make one plea, I guess, which is, don't hate too much on McGraw-Hill, because I've taught in Cengage. They have a version of this. I've used my accounting lab, which they all stink in different ways, and they all have positive things in different ways. What's positive about it, okay, is when I first started teaching accounting, you would do it on paper, you'd submit it to me, it would take me a week to get them all graded, and by the time you were getting any feedback, you were moving on to a new concept. So the positive thing is the immediate feedback, but sometimes when that feedback isn't really helping you. One other thing I would add, real life accounting is easier than classroom accounting. And the reason for that is, you know what's happening in the transaction in real life. There's not some big giant word problem that you're trying to ferret all the facts and details out of and figure out which information is unnecessary. In real life, you're just like, oh, okay, we just received money, so I know my cash is going up or whatever. So don't despair. If part of the problem with this class is, it's like, here's a giant word problem. And then for our poor students for whom English isn't a first language, add that on top, reading giant word problems in a language that's not your native language. All right, we're running short of time, and I want to make sure, any other questions I could try to address. Melanie.
I have one question really quick on that same problem. It's
Okay.
asking for the debt ratio, and it's asking for it in percent.
Uh-huh.
So instead of like 0.5, it's 50%, right? Okay. I mean, I assumed that's what it was. It just, in the book, it never takes it to a percent. It just
Right.
was always like, 0.5 or 0.7 or whatever. Okay.
Yeah. And just so you know, that's a real world problem too. In one, sometimes if you're working in multiple systems, one system will have things recorded in absolute terms like 0.707, and then the other system will want it in percentage, and you have to like convert that, which is not a major conversion, but it's frustrating at times. So
No, it's totally fine. I just that's just another McGraw-Hill quirk where it teaches you one way and then it asks you a different way in the quizzes.
Yep.
Okay, that's all. Thanks.
I think it's, yeah, I think it's institutionalized bullying personally, but
Something like that.
all right. All right, are we good for, is that enough for one night? Usually we reach a point where our bottoms can't handle more of this meeting. Again, state conference, if you're sitting on the hard metal chairs, I don't hear what they say the last hour. So anyway.
That's why the video feed when they're doing that is
yeah, I hear a lot of people so it was interesting when I was bishop, we started like for COVID, like broadcasting, even sacrament meeting, right? And so you'd have, whenever missionaries would speak, their parents from back home, it was kind of a cool thing. And then like when bishopric changed and our new bishop came in, like the first thing he did was get rid of that. And I was just like, your funeral, buddy, good luck with that. But it seems like it's been fine. All right. Okay. Well, thanks very much. I hope something was worth your time tonight. And if nothing else, my shirt. Yeah, thank you for coming. Can I get a volunteer to give a closing prayer?
I'll do it.
Great. Thanks, Larry.
Our dear Heavenly Father, we're grateful for the opportunity that we had to be able to meet tonight virtually online and to discuss the accounting class and the principles that we need to learn as part of our classwork. Bless us that we'll be able to study in an efficient manner. Help us that our minds may be alert and attentive to those things that are being taught. We're thankful for our instructor and grateful for his time and talent. Ask you to bless him and watch over him. Bless us that we'll be able to continue to learn and expand our knowledge of these principles. These favors and blessings we thank thee for and ask thee for in the name of Jesus Christ. Amen.
Amen. Thank you very much. if anyone's on here from Accounting 101, I'll be ending this meeting and then restarting so that I'll have separate recordings. So don't freak out if it like the meeting ends and it drops you out. Laurelyn, did you have a question? There was like a hand flip, an indicator of.
Oh, sorry. No, did I not turn off my raised hand?
No, it was your actual physical hand.
No, I was stretching, yawning, scratching my head. I apologize.
It's okay. How dare you have a human interaction in a non-human environment?
I know it. I was up till 1 trying to finish my homework last night, and then I get up at 5 for my work, and I'm just tired.
Okay.
I did have one other thing that might be helpful in remembering debt ratio, whether it's if the higher number is good or bad. When you go to get a loan, they look at your debt ratio. So the higher the debt ratio, the less likely it is that you'll be able to get a loan from the credit union or bank. So just remember.
Yep. Yeah, just, to me, like ratios are relative measures, right? We're measuring the relationship between two things. And so I have to know like what two things am I measuring and what is my goal? So, or what is, what's the target, so to speak. And so, that's how I just always think of it, like, because other ratios, it will be the opposite, right? Where we want higher. And there should just be like a little cheat sheet somewhere. There probably is if you Google it, like higher is better or worse. So I swear everything's on Google. I don't know why there's another reason real life accounting is easier than a class. You could Google stuff if it's stuff you don't refer to very often.
Yep.
Anyway, all right. Have a great night, everybody. Thank you.
Bye.
Thank you.
Bye.
Brother Fox, thank you.